You get into a company that's a small company but still traded on the market. So you add a little bit more risk to that because it's not the Procter & Gamble, it's a smaller company. And when they talk about small companies, small cap companies in the stock market, they talk about sales of $100 million to $500,000, 500 million, so very large companies. And so, but nevertheless, you add a premium to it. So instead of 4.5% or something like that, you're talking maybe now 8%, something like that. And so if you are starting to talk about a very small company, then you would add another premium on it. And then another part of the risk is what the risk you see in your company. Say, for example, if your sales were to one company, or you had two companies, customers that you sold to, that would be considered a high risk atmosphere that you're in. Or if your supplier is one company, or your supplier is maybe two companies, and that's it. Like, what's it, Foot Locker. 86% of their products come from Nike. So that's a high-risk business. So you add a premium for those risks that you see. You take a look at the management, or if I was valuing the company, I'd take a look at the management and see what kind of education background they have, what kind of experience in the field they have, and how they've operated companies in the past to sort of evaluate how good the management of the company is. And so those are the things that go into this valuation. Now, I have, in arriving at all these numbers, I know it's all confusing to you, but arriving at all these numbers, we have these books we subscribe to. I subscribe to this Business Valuation Update, and on the back of there they have a cost of capital center where they talk about all these tax rates. And this one is for October. No, I'm sorry. This one's for October, and they talk about the Treasury yields for a 20-year Treasury bond is 2.91%, so it's higher than what you would think. Back in May, this is the May one, the rate is 3.35%, so those things have changed. Now they also have in this the cost of capital for a very small business. And the cost of capital that they talk about here, if the revenue is $1 million or less, it's 18.65%. And if it's $15 million or less, it's 16.02%. And it hasn't changed much. In May, it was 16.4%. So these are sort of the numbers that you can put your hat on and use in determining your value of your company. And we have, if you take the net income of $50,000 and you divide it by this 16.2%, that's pretty good what the value might be. Now what I do when I value a company is I do that, plus I take a look at, I check my valuations based on the rule of thumb. And the rule of thumb for maybe janitorial service is 45% of annual sales plus inventory. I don't know how much inventory a janitorial service would have, but they would have some. And so if you take the annual sales and you take 45% of that, that's what the value is. Now the problem with the rule of thumb in that case, in all these cases really, are they're not taking into account any specific risk for your company. So management risk, concentration of supplies, concentration of sales, all kinds of risks that you would be faced, these are not taking that into account. So that may or may not be a value, but it's certainly a check on what I come out with by doing the capitalization of income method, for example. Another one is 1.5 times SDE plus inventory. SDE is the seller's discretionary income, and you take the net income, you exclude the taxes, and you exclude the non-reoccurring items and the special items, and you exclude the depreciation. And so there's a calculation to that. You come down to that, but you could do that, and it's 1.5%. In injection molding, the rule of thumb is 4.5 to 6 times earnings before interest, taxes, depreciation, and amortization. So you have to go through that calculation in arriving at that. And the engraving retail store, John and I sort of arrived at this from some publications I have. 15 to 20% of annual sales plus inventory, and they would typically have more inventory. So you can sort of check your calculations against those and arrive at some kind of value. It's important to do these. I think that's the end of my slides.
Oh, there's 2 more. This one.
Okay. Okay, when to do evaluation, it's important as we mentioned to start with, if you're ready to sell your business, you want to know how much to offer your business for and how much it's worth. So it's important to take a look at that. When the owner is retiring, changing the ownership of the company is important to them and retiring, and so you need to have some kind of evaluation at that point in time to know how much the transfer, how much the gift was, how much the sale might be, all those things. Death of an owner is very important to arrive at evaluation at that point, because for estate tax and income tax purposes, the tax cost of your company goes up to whatever that fair market value is, with no intervening tax on that increase in value. So it's important to get the value up there, so it's maybe important to maybe hire somebody like me to arrive at evaluation depending upon the magnitude of your estate. And right now, for federal estate tax purposes, you have an exemption of $5.5 million or a little bit more than that. And for the state of Washington, the exemption is $2 million per person. So you have to double that if you're married. And so you have to have a pretty sizable thing, but even so, for income tax purposes, you want that value to go up, and there's no annual exclusion or lifetime exclusion for that. You just want it to go up and use that as a tax base when you eventually do sell it. So, for example, if the owner dies and his children inherit the company, and then they don't want to operate, so they want to sell it. They could sell it for whatever the value was placed in the estate, and there'd be no tax on that sale. So it's very, very important. And gift to the next generation, if the person wants to retire, he wants to give the company to his children, and they are interested in operating it, then there's potentially a gift tax, so you want to take a look at the value there. Next slide. How to enhance value. Companies that have high risk are the ones that have a net income of this year. And up here is the net income next year. And then down here is net income. And so there's wide variations in the net income. And that's and you look at that evaluation, the person looks at that and they look at a high risk. So if you can make your sales and make your net income gradually grow on a somewhat even plane, then that would be enhancing the value of your company, reducing the risk. You want to pay attention to the margins in your company. You want to have accurate financial statements so you can take a look at those margins, those percentages, make sure they're right, make sure your net income gets up there. And that's easy to say, but it's really difficult to do. But the people that own franchises are taught that. That's how they make money. They go in and they buy a franchise, and there's a model set up. and the franchisor says, okay, you do it this way or you're out. And so they have the sales, they have innovations, they have everything else already preset. And so all you have to do is follow those steps. And in order to follow those steps, you have to have financial statements that show those margins. They want 42% labor, and they want 38% in food, and there's all kinds of percentages that they have, but they pay attention to them, and they're very meticulous, and they on the net profit, some of them look at it weekly, and so they're very careful, and they have very accurate financial statements. With balance sheets of unwanted assets. Sometimes people buy cars, vehicles, and I've seen boats, airplanes, all those things that a buyer is not going to buy. And so you want to get those out of your books to make it realistic. And develop a business plan and follow annual income and expense forecast. What a person, when he buys your company, is buying is the ability to make cash in the future. That was what was in the past. We use the past information as a guide as to what's going to happen in the future. And so you have to have a very good business plan which keeps you on course to develop that income. And then from that you can do forecasts as to what's going to happen in the next 5 years. And it should be a rolling forecast. So 1 year drops off, you pick up the next year. And so you can keep going on that. And the forecast not only helps a person value the business because they know what they're going to have in the future, but also they would be able to be comfortable about those figures and use those in their own evaluation. And I don't have any others for you. And I think
We're at the break.
we're at the break.
Thank you very
John.
much.
It's a pleasure.
I have any questions for Bob? And there's a lot that we could discuss on this.
Yeah.
And what we're going to do now is we're going to start with a question. So if you go to your website
And refresh it.
and hit refresh, and there should be a place to put in your first name, your last name,
And the company.
and your company name. And then you can get fresh coffee and have a muffin, have a piece of fruit, and relax and ask questions for the next 5 to 10 minutes. Thank you.
Michelle, Rich, Risana, would you guys like a muffin? There's
Not
muffin.
yet.
Oh my God.